Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing NGL Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. NGL Energy treats, recycles, and disposes water as part of the energy production process. It's also a diversified midstream company that transports, stores, and markets crude oil, natural gas liquids, and renewables to oil producers and end users. The company is headquartered in Tulsa, Oklahoma, and was founded in 1940. It went public in 2011 and trades on the New York Stock Exchange and Deutsche Börse. In February of this year, it closed a $2 billion, 7.5% debt offering. $500 million of that is an asset-based credit facility. They are deemed so risky, the lender wanted them to pledge assets in order to give them the loan. Also, they're paying a very high interest rate of 7.5%. The company is a big credit risk given these terms. I can get a loan for a lot lower than 7.5%. Granted, the loan is nowhere near $2 billion, but a big company should be able to get a loan for 3 to 5%, especially given how low interest rates are. The lender also required NGL to suspend dividend payments to its common and preferred stockholders. The company has been reducing its dividend well before they entered into this debt agreement. It cut its dividend in half in May 2020, then cut it in half again in November 2020, and then suspended it entirely in February of this year. NGL is a master limited partnership. MLPs pay a lot less taxes than a traditional corporation. That's because it's able to avoid double taxation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. Let's get started with the model. This is a micro-cap company, 298 million market cap. They're trading at $2.30 a share, and they have 130 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow in 2018, 19, and 20, but they did have a positive in 2021. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that's negative every year except in 2019. Revenue is the sales for the company, and that seems to be decreasing each year, down to $5.2 billion in 2021. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. Then below that is operating expenses. Gross profit minus operating expenses gives you your operating income. And they do have positive operating income each year. But they do pay a lot in interest payments on their debt. So they do have negative net income in 3 of the 4 years. They do have some big negatives in other income and expenses. These negatives are the losses from the sale of an asset. So to give you an example, if a company purchased a machine to make products, say they paid $10 million for the machine, and then several years later, there was a newer model of that machine. So they bought the newer model and sold the old one. But say the value of the old one when they sold it was $5 million and they sold it for $3 million. So they would have to book a $2 million loss onto the income statement and other income and expenses. If they sold the machine for a profit, then they would have to book a gain in other income and expenses. You can see this $91 million gain in 2018. It goes into other income and expenses because their business is not to buy and sell machines. Their business is oil and natural gas. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So it's good they're generating positive operating cash flow each year, but they do spend a lot on CapEx just to maintain their business. So they have negative free cash flow in 3 of the 4 years. They did have positive in 2021, because they spent a lot less in CapEx than in prior years. They did pay down debt in 2018 and 19, but added $1 billion of debt in 2020 and $200 million in 2021. They're also issuing a lot of capital stock, $200 million in 2018 and $600 million in 2020. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. so it dilutes the current shareholders. Although they did buy back $266 million of capital stock in 2020. The statement of cash flows doesn't look so terrible, but they're going to have a really hard time paying off the interest on their debt, as well as maintaining their business and trying to turn a profit. Things don't look so great for this company. Let's look at the capital structure. $1.4 billion of equity, $3.5 billion of debt. They're 29% equity, 71% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 7.2%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of negative $417 million. We divide that by 130 million shares. And we get a calculated stock price of 0, since you can't have a negative stock price. So according to my model and according to my analysis, it looks like the company is not worth anything. I have a good feeling they're going to file bankruptcy this year or next. They're in so much debt, and they're not really profitable. Unless business improves a lot, I don't see how this company can turn it around. Simply Wall Street doesn't agree with me. They value the stock at $22 a share. They're saying it's really undervalued. 2 analysts priced this stock and their price target was $2.30. This is a stock price since it started trading, so it looks like it was trading over $40 a share at one point, but then it came down since then. There's a pretty big increase here, but once it hit this peak, it never got above that point and just kept coming down. So in June of last year, the stock was about $5.50. There was a small run up at this point, but usually when there's a quick run up in a stock, people take in their profits and sell off, which push the price even lower. And this is a really volatile stock. Their beta is close to 3, so the stock moves 3 times the market. And the stock went down 59% in the past 52 weeks, while the S&P 500 went up 36%. The 52-week low was $1.87, and the high was $6. The stock is trading below its 200-day moving average and trading at its 50-day moving average. About 2 million shares are traded each day on this stock. Of the 129 million shares outstanding, 122 million are on float. When a share is on float, that means it's available for investors to purchase. The 7 million of shares that are not on float are held by insiders and cannot be purchased. 38% of the shares are held by institutions. Over 4% of the shares on float are shorted. This stock has really struggled the past year, 3 years, and 5 years, down a lot, while the market is up a lot in those time frames. Their industry is up a lot in the past year because oil prices are coming up, but in the past 3 years and 5 years, their industry is really struggling. Analysts are projecting their earnings to grow 119% and their revenue to grow 10%. I guess since their earnings are so low, they're expecting these big increases. In the past 5 years, this stock has gone down 33% on average each year. In the past year, this stock has gone down 99%. These numbers are much worse than its industry and the market, although in the past year, its industry went down 43%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have been close to $30,000 at one point. But if you still held on, you'd be down to $3,300 today. That's a 67% loss. The biggest shareholder is Invesco at 15%, then Morgan Stanley, JP Morgan, the CEO of the company, owns 2.5% of the stock, and then last is Advisory Research. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price to sales is really good at 0.1. That means investors are paying 10 cents for $1 revenue. A price to sales this low indicates the company is a great value. It's trading at a deep discount. But whenever I see a price to sales this good and negative earnings, that's usually a value trap. A lot of companies in this position have gone bankrupt. Because if they're trading at such a great value, why wouldn't more people buy the stock? If you have a price to sales ratio of 1, which is really good, that means your revenue is equal to your market cap. 0.1 means your revenue is 10 times your market cap. They're actually even better than 0.1. They're at 0.06. To give you an example, a company like Google, 1.6 trillion market cap, their revenue isn't close to 1.6 trillion. It's 200 billion. So their price to sales is 8. So why would you buy Google over this stock? Because Google is a good company. This company is really struggling. So you have to look at more things than just one ratio like price to sales. You have to combine it with other ratios. Their price to book is also really good at 0.2. And price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have $1.4 billion of equity. That's why their price to book is so good. But they have negative tangible book value because they have $2 billion of intangible assets on their balance sheet. So their tangible price to book is negative. It's really poor. Their return on invested capital is 1.7%. That means their return is 1.7% on each dollar they invest in their company, and their WACC is 7.2%. That means it costs them 7.2% to borrow money. So every dollar they invest in their company, they're losing 5.5 cents. Their interest coverage ratio is 0.4, so they can cover 40% of their interest payments with their EBIT. Negative net income, so negative ROE. Their current ratio is above 1, so they can cover their current liabilities with their current assets. But they don't have much cash on their balance sheet, only $5 million. Most of their current assets are receivables, $730 million. So other companies owe them this money. And they do seem to be well capitalized. They had over $100 million of free cash flow and $100 million of working capital. So they have over $200 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 8 companies in the same industry as NGL. And if NGL has a number in red, they're worse than the average in the industry. If they have a number in blue, they're better than the average. So they're much better in price to sales and price to book. They're red in all the other ratios. They're a really small company at 298 million market cap, much smaller than the average. And most companies in this industry have cut their dividend or suspended them entirely. NGL is one of the companies that suspended their dividend. So to summarize, I feel this company will probably file bankruptcy this year or next. Unless there's a drastic turnaround, I don't see how they can survive with all the debt they have, and they can't even scrape together a profit on their regular operational business. But that doesn't mean you can't make money on the stock. If you buy the stock and there's a big run up in the price and you sell before the price comes down, you can make money. Of course, that requires timing the market, which is really difficult to do. I rank their free cash flows 5 out of 10, their revenue 2 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.